Hey everyone, welcome to another Market Radar podcast. Hope you've had a great week. Let's take a look at the Nasdaq. Really not much movement going on in equities this past week. Both the Nasdaq and the S&P, not much movement. We did see a reversal in bonds. So that deflation trade still not quite playing through. It is on our radar, but we don't front run the system. We let the system play out. Right now, ZB is not pointing towards deflation
yet. But
yet. Not yet.
Let's go over here what happened in NQ this week. So obviously, year to date, Nasdaq's up 32%, and we're only 6 months into the year. So everybody is excited, or I should say, everyone's got some emotions running through them, thinking either one, they're missing the move, or two, they need to short this move.
Right. Now, there's FOMO in full force right now.
Right. And the big thing I would say that I wouldn't do is at Market Radar, we don't short bullish trends. Trend flipped at the end of the end of Q1, quarter 1, 2023, and it has been bullish trend ever since. Now, trends do revert, or prices do revert towards trend, I should say. The price can come down without a doubt, but a lot of damage has to be done here in the Nasdaq to flip the trend. For an example, from where we closed on Friday, the Nasdaq would have to fall 12.8% just to be at Momo. That's not flipping the trend yet. So there's 12%, almost 13% of downside here, and we can still remain in a bullish trend. Now, what are some things that you can watch in case you're wondering how these shifts can occur and in what manner they would occur if price would start reverting lower? The simple thing is to look at mid-vamp, and we post most of our charts with mid-vamp. And what mid-vamp is, it's the middle of the upper and lower price ranges, which we call our VAMPs, our volatility adjusted market projections. So the white line here, this is mid-vamp. Now, when this white line, when price is above this white line, it tends to chug higher. And when price really gets below this white line, it breaks lower. Now, you can use this as a gauge. And if we take a look at what happened in NQ this week, price held mid-vamp, meaning we weren't able to get below it. And the way you have to think of the way price moves is in stages, right? So if you're all the way up here near upper vamp, the red line, what has to happen for you to get to Momo if you wanted to speculate or however you see fit? Well, two things would have to happen. You would have to lose mid-vamp because you can't go to lower vamp without losing mid-vamp, right? So this stage one. Then you would have to lose lower vamp and consistently press lower like we do here in bearish trends like this. And that usually happens when price stays under mid-vamp. So the price needs to stay then under mid-vamp, break under stage one, stay under and push lower vamp stage two, and that's how you get to lower vamp. So keep it simple, stupid. If price doesn't get under mid-vamp, you're not going lower. It's that simple. Now, you can see here, we've had multiple rejections throughout the past couple of months. We actually got to lower vamp in April, rejected up, tried to go lower again, and we got back above mid-vamp and just rode the wave. And this is what happens. Again, this is not just Nasdaq. Let's move over to bonds. Similar thing is happening here, right? Once we get below mid-vamp, price really starts accelerating towards lower vamp. And once price gets above mid-vamp, you have the ability to accelerate towards upper vamp. So you have to, again, play the scenarios how they lie. We are looking for the bond trade right now. Our regime model remains risk off. We're looking for the bond trade. So how this plays out is going to be as follows. Bonds will have to go bullish trend, which means bonds have to cross this yellow line up here, Momo, for them to go bullish trend. Now, for bonds to cross this yellow line and go bullish trend, two things need to happen. We have not been able the last few sessions, the last couple of weeks, to get above and hold above mid vamp. That's stage one that needs to happen. And then we need to bust through upper vamp as stage two. That'll get us to Momo. From there, price will have to break Momo to flip trend. That would be the third stage of the three-stage program here for us to get involved in bonds. If that doesn't happen, bonds will not go anywhere. Bonds will chop and go lower or sideways, most likely sideways. We don't think bonds have the same downs. We've been saying this for about 6 months. If any of you have been watching us, you'll know this is a very common saying at this point. Bonds no longer have the same downside risk. They have the chop risk. We've been saying this since pretty much November or whatnot of 2022. And we've done nothing but chop. So we got that right. Now the question is, when are we going to get the pivot? I think the pivot does come relatively soon, but we won't front run the system. Like you said, Artie, this is not a game of just throwing your cards on the table. Yeah, we have to be strategic. Right. We have to know when to fold them and when to hold them.
We're just waiting like snipers right now, and
exactly
it can come quick, especially with this week coming up. Now we do have CPI and FOMC next week. Those can definitely move bonds, and a movement up to Momo, the yellow line there, is very possible next week if we do get some sort of surprise in the CPI print.
Right. So let's go over what's going to actually happen next week. Obviously, we've been speaking about it, but let's talk about the actual schedule here.
Yeah, so we've got CPI on Tuesday, followed by FOMC on Wednesday. So those are going to be the two main days we're looking at. We also have retail sales on Thursday, which is going to be very important. So we do have some catalysts that can move bonds and bring us closer to that deflationary trade, but we're not going to front run it. We're going to wait it out, see the data that comes out, see how the market reacts to it, and base our actions on what the market is telling us after it sees this information.
Right. So let's also talk about in regards to bonds, right? Because this is pertinent to CPI and inflation, CPI and the Fed. Why wouldn't bonds go? There's obviously some people that think, and this is outside of the Treasury, upcoming Treasury issuances and whatnot. And all that really is just a liquidity concern, but we'll put that aside. A lot of people think that structurally inflation will stay higher for a lot longer. Let's just say you take 4% inflation, right? Call it what it is, 4% headline. And you leave it at 4% for the next 10 years or 20 years, structurally higher for longer inflation. Then the bond rates are where they are right now for the 30-year bond is at 3.88%. They're about right. But the 10-year, some of these bonds are undervalued, right? In terms of like they need to go up, like even the 30-year needs to go up about 20, 30 basis points from here to be properly valued. And that's not going to be a positive real yield if we're going to actually, right? You're not going to yield anything after inflation if bonds are at these levels, if inflation is structurally higher. And that's the argument a lot of people are making. They're saying, well, inflation can be a lot stickier for a lot longer. And they are right to a degree. Inflation is definitely going to be stickier, but the question is where it's going to be sticky. And that's the question you need to be asking. And if we don't think inflation is going to be sticky in the expectations of where the market thought that it would be back when we were, trading 118s on ZB. And that roughly, if we pull up TLT for those that don't trade bonds, that was at the 90 range in TLT back in, all right, let me take the dividends off. Most of you guys just look at straight share value. That's at 92 back in October of 2022. For bonds to get down there, we'd have to have a serious reprice of inflation expectations going forward. What do I mean by inflation expectations? Well, you can look at the University of Michigan, the surveys. You can look at Fed expectations. What we look at is we look at market expectations. So let's take a look at the 5-year break-even rate. Now, the 5-year break-even rate is basically what the bond market, the Treasury inflation protection securities, the TIPS, are pricing in as the hurdle rate in the bond, being after their real yield, or what they're going to yield after inflation is expected to be 2.14% over the next 5 years on a yearly average. So what this is telling you, and remember, from March of 2022, we were at 3.61. So we've come down significantly. And the question now is, can we go lower? And I think that this is where things become tricky between inflation, the Fed, and how they navigate the scenario from here. Because if you really want to see, like, realistically, I put a diagram out on Twitter, and I will say this again for those that didn't see it or are new to the podcast. If you want the Fed to hike, you need to see these higher. I think we're going to get the pause, and we'll go over that in a little bit. But if you want to see rate cuts, I think we need to see this lower, meaning under 2%, you start getting rate cuts. Above 2.4, 2.5%, realistically 2.4, you get those rate hikes accelerating again, meaning the Fed terminal will go higher than 500 basis points. And most likely, if it's going higher than 500 basis points, it's not going to be one hike. We're probably going at least 3-4 hikes. It's a start of a mini hiking cycle. So you have to watch break. I would watch break evens if I were you. I'd keep focused on how they are moving. Again, under 2, I think we start seeing rate cuts, unless obviously the economy, the labor market starts imploding in the process. Meaning, I think that we could essentially, when I say under 2, the market can slow without killing labor to a degree. And what I mean by that is labor can remain tight, but the excess in the jolts, or I should say in the job openings, which is jolts, that can basically be vacuumed out, and you would have a somewhat tightening of the labor market. Yet employment remains not strong, but not weak. It's still robust to a degree. So that would obviously be a sign of slowing growth and a slowing economy. It wouldn't be that detrimental to the overall labor market, but it would certainly help slow inflation. And Powell's made some notes about this in press conferences, or in when he was sitting in, and he was on trial, or he was in front of Congress. He was making these statements when they were interrogating him, and they were asking him certain questions that he had really no business answering, but he had to. And in terms of like wanting people to be fired, to basically insinuating that their goal is to fire people to meet their policy goals. And he made it somewhat, or made a remark and pointed towards the fact that jolts can slow, and it has a good shot at helping the inflation fight. So we have to watch that. And jolts are now 15% off their 2022 highs. So there's obviously some weakness emerging in the labor market. We saw unemployment rise this week in jobless claims. So things are obviously working on. The unemployment rate last week came in higher. So obviously things are working out in the way that the Fed wants, which again brings us back into the Fed hiking rates this week. We do not believe the Fed is going to hike. Right now, the market has a probability of 28% that the Fed is going to hike. And we'll go over that when we go into the Fed in the last part of the podcast. But let's go over inflation. What does the market
hold on, before we move on, I just want to
talk
about. So it seems like the likely scenario is what you mentioned, where unemployment it doesn't really weaken too much, but it also it kind of comes off the lows. So we still would maintain a fairly strong labor market while still having inflation cool down. What does that entail for the bond trade?
Right. Okay. So what that's going to entail is, or I should say, the story that's going to get put on if that happens, if you have inflation come down more. I mean, even if the inflation comes in where it's expected to in the next two prints, you're going to have this solidification of the soft landing. Basically what's going to happen is people are going to say, wow, we fixed inflation without destroying employment, the soft landing. The problem that nobody pays attention to or in regards to is the soft landing isn't possible. It's not. When I say it isn't possible, not it is possible. It isn't possible. So why is it not possible? Well, we know what the Fed is doing now is slowly starting to emerge into the market. I mean, we're about a year and a half into a hiking cycle, right? And we've come up at some of the fastest pace one of the fastest paces in history, from 0%. Now the question is, how long does going from 0 to 500 basis points take to bleed into the economy and start affecting things? Because if you look at prior hiking cycles, we've never come from 0 to 500 basis points. That's such a huge move in a rate of change basis. Yes, it's only 500 basis points. We've done more in 1980, right? In terms of hiking, 500 basis points. But we had the world hooked on ZIRP, zero interest rate policies, and we just jacked it to 500 basis points. Obviously, there's some implications of this. How they bleed in, we don't know today. And we have to assume that there is going to be some negative effects from this, because that's what raising interest rates do. And you can argue that raising interest rates are inflationary, but that's all a bunch of MMT nonsense. You have to pay attention to why does inflation slow when rates are raised? Well, it's because you're creating a demand for capital to be sucked out of the system, right? Which is going to slow the flow of capital and slow the demand for goods.
Right, and
And that's
it's
what
been working. Like we've
right. It's
seen
been working.
it happening. So it's kind of funny that people still have that argument that it's inflationary.
You know what
If
it
it
is?
was inflationary, wouldn't inflation have gone higher once they started raising rates? It
You know
kind
what
of
it
defeats
is?
the whole argument.
It's this. This is the problem. It does defeat the whole argument, but this is the problem. Uh, MMT blew up in everyone's faces that believed in it back on the lows, right? Back when interest rates were zero, not at the lows, right? ZERP. That's the move from 0 to 500 basis points. That was like theoretically the Fed didn't. If MMT was possible, the Fed wouldn't have had to raise rates,
Right.
right? So the fact that the Fed had to go from 0 to 500, we had basically on the verge of runaway inflation without the Fed raising rates. If the Fed did nothing, we would have seen CPI, well, I would assume north of 15, 20% easily. And it definitely would be structurally higher. Like we would have had that boom that would have basically cemented a higher plateau of inflation. And that is something that disproves MMT, right? And since the whole MMT camp was basically invalidated the last 16 months or 18 months, they now have to take a different approach because it's a cult. You can't invalidate the one concept of, like, think about the Bible, right? You can't invalidate 2 or 3 of the 10 commandments and then have full faith in all 10 commandments. Like you have to defend every one of them vigorously, and that's what they're doing. They're trying to find an angle to defend what their thesis is, and that's okay. That you can let them do whatever they want. But at the end of the day, MMT doesn't matter. These concepts, these are theories. They don't mean shit. What matters is what's happening today in the market. Where are bonds? Where are equities? Where are rates? Where are commodities? Where are they going? Let's make the move. Let's capture the change in price and let's make money. All this other stuff, it's something that you basically use to cope and go to sleep at night, saying you understand the market. You get MMT. You know, you can lay in bed and while you're wrapped up in your blanket, you're like, oh yeah, modern monetary theory. I know what I'm talking about. I'm safe.
Yeah,
Like it's what
playing
this is.
mental gymnastics with
Yeah,
all the other
playing
macro guys.
right.
Yeah.
Nonsense.
At the end of the day,
Nonsense.
we're here to make money. We're not here to follow narratives or, be like the guy that knows everything and be the macro guy. At the end of the day, we just want to make money. We
Yeah,
we
doesn't
know
matter.
what we know and we talk about what we talk about because it makes us money. And
Right.
that's why we talk about it.
Exactly. And I have built for the members that are listening to this, you guys already know, but for those that aren't or new or aren't subscribed, I have a channel in the Discord called Ledger. I build narratives in the Ledger. Now you might say, what, why would you're so against narratives, all this shit talk? Yes, 100%. But my narratives changed. They're not true narratives. They're not cemented. They're backed by our data, our quant, basically our quant work. They're backed by math. So if the math changes, the narrative changes. It's very simple. But I have to formulate these narratives for people because at the end of the day, the reasons why narratives sell so good is because people are unfortunately so simple. And it's not, I don't mean that in a derogatory way. If I were to go run through the data, you would look at me just in confusion. But if I simplified it into a 30-second story, you would get it and you would understand it and you would believe it. You won't believe the data, but you'll believe the story. And that's why narratives exist. So narratives have to exist for the general consumption of information. Otherwise, people don't understand what the hell you're talking about. And that's why most of what we talk about in the podcasts are built around our narratives, which in turn are built around our data. So it all comes back to the data. If the data changes, we change. Most of our members know by now we have not been we have not been caught in any situation where the market has moved in the opposite direction and we stay locked in the thesis. I mean, we've been saying equities can go higher ever since end of March, pretty much. We've been saying that beforehand, but in terms of our system positioning, but in terms of what the market could do, once we went bullish trend, market can go higher, no problem. No problem. We have not fought it since. We have not said anything about the market going higher. There's no reason why the market can't go higher from here. The trend is bullish. We are in a risk-off regime, though. But again, follow the data. The data is saying the market can go higher even though you're in a risk-off regime. That means the market can go higher and you're in a risk-off regime. It's not very hard to understand. It doesn't make sense, maybe, if you look at it. You say, but we're risk-off. Oh, the market should be crashing. Okay, but it's not. Market's bullish trend. Don't fight the trend. Let it play out. It can go higher even though we're risk-off. Now, bonds. Let's look at bonds, for example. Bonds right now are bonds are bearish trend. Now you might say we're risk off. Bonds should be going up. It should be bullish trend. Well, they're not. You know how many people we've spoken to that got chopped up in the bond trade, and people we spoke to that have avoided the bond trade by taking our information off Twitter and saying, man, it might not be the right time to buy bonds. Long story short, what I'm saying is bonds have gone nowhere, but they should have gone somewhere given the risk-off regime. Why have they not gone anywhere? Well, bonds are bearish trend. Risk-off bonds are bearish trend. Can't be long bonds. It's that simple. So you have to break things down and understand them in simple terms. And this is why narratives are important. Just because you think you believe into a narrative doesn't make you stupid. It's what everybody does. But just understand that 99% of the narratives that you're listening to are bullshit because they don't have the data backing the narrative. They have emotion backing the narrative. And then what that does is it screws up the whole paradigm of what you're listening to. You're listening to somebody's feelings. You don't need somebody's narrative. You can feel yourself. You can look at the market and generate your own feelings and have your own narrative. You don't need to listen to somebody else in that case.
And an issue with doing that as well is, at what point are they wrong? Is it
when the market hits a new all-time high?
When their feelings change, they're wrong, and they realize that their narrative is wrong when it's too late. That's the issue.
That's a major issue. That's why a lot of people are, you got a lot of bears out there short the Nasdaq for some reason. They think it's 2001 all over again. 2008, they thought, the market's going to crash. 2020, they think, 2019, the market's overvalued. You got all these reasons why people are short the market. We're not short the market. It doesn't make sense. It does not make sense. If you want to short the market, you had this whole time to be short the market here from early 2022 to end of to mid 20, or I should say Q1 2023. There's no reason to be short this market. Now let's go into the last segment here quickly, the Fed. Obviously, we've been speaking about this. We think the Fed's going to hold. The market's putting in about a 29% chance that the Fed hikes, that the Fed does hike, which means that there is a 71% chance that they hold. We think that they hold. We follow the market. Typically, the front end of the Fed funds futures, which is the next meeting, right? The first meeting, tends to be right the closer you get into the meeting. So we're only Monday, Tuesday, Wednesday, we're 3 trading days away. So at this point, I do think the Fed's going to hold. We've been saying the Fed's been going to hold for a while now, even when the market was pricing in the Fed hiking. And this is primarily due to some overreactions with economic data, which the Fed is a very simple entity. They don't like surprising the markets. They do sometimes. It happens. But they removed verbiage and almost put on this quasi show last time that at the last meeting that they were going to slow the pace, the path of policy, insinuating a pause. Let's see if they actually do that, but that's what we believe they'll do. They've been very clear also this entire year so far about getting rates to about 500 and holding throughout the year. Maybe it's 525. Maybe they hike one more time and they just hold. That's a possibility, but I don't think they're going to hike. A lot of people are thinking the Fed's going to skip. That's a bunch of nonsense. I don't think the Fed's going to play that game. I think the Fed's been the strongest central bank out there in terms of fighting inflation. There's no reason for them to stop and then start hiking again. And the market's also pricing in an 88%. So remember, 88% chance that rates will be within one hike or one cut by the end of the year, meaning we're in a tight range now for the end of the year, around that 500 basis point mark. So to think the Fed's going to hike now, skip, hike, hold, and then cut makes no sense. I don't see how that we're talking about. So we got 1, 2, 3, 4, 5 meetings here. The Fed is going to skip, hike, hold, cut, and potentially cut in one. So the Fed's going to skip, hike, hold, cut.
Yeah, it just doesn't make sense. There's no way that's going to happen.
Right. So something's wrong in the curve. I think the Fed's going to hold, and ride it out because there's no reason for them to hike right now. The economic data is working in their favor, unless obviously we see a resurgence in. I mean, we saw the unemployment rate tick up, right? We're seeing jobless claims pick up, inflation's coming down, the number of job openings and jolts are coming down. A lot of things are going in the Fed's favor now. We may see the Treasury issue more debt and basically restock the Treasury market, which would be just good for market function as a whole, potentially sucking some money out of a reverse repo, which again adds liquidity or transfers liquidity into the system. However you want to play with that in your head. Long story short, these are all good things that are happening. There's no crunches going on here in terms of the Fed having to basically start QE. Like there's no stress yet, and unless that stress emerges, I think the Fed can hold 500 basis points for a while, for at least to the end of the year. Maybe you get to the end of the year and they can go longer. I don't know. Or maybe we get a meeting in, 2 meetings in, and unemployment skyrockets to 4.5%, 5%, and we got problems. And like obviously the Fed's going to then start cutting rates and start accommodating and trying to slow the blow of a growth slowdown that would happen in that environment. And eventually, as I said earlier, I do think the hard landing comes. No, the hard landings are not avoidable. They happen. The Fed is not the savior in terms of they just basically amplify what's going on, right? Meaning, if we have a recession, we have a recession. There's a growth slowdown. It happens. The consumer gets burnt out. The Fed basically can accommodate that, but they just add basically gas to the fire for the rebound. Meaning they accommodate that, inflation comes in, asset prices run, everyone gets joy. Then the Fed has to go against that, and then that's where we were in the last year, where asset prices fall, inflation is on its way down, and people are uncomfortable. And this is how this works. This is the cycle. Long story short, Fed holds. Let's see what they do next week. We'll talk about it next week. We'll see what they do and what they say. I think we'll see 500 basis points throughout the rest of the year at this point in time. Thank you guys so much for listening, and have a great week.